Hello, everyone. I am so excited. I have Ken McElroy from MC Companies here, and I just want to introduce you to my best partner. He has spent over 2 decades running a successful real estate business and in the real estate world, from investment analysis and property management to acquisitions and development, and has over $750 million of investment dollars in real estate. And Ken offers an amazing, unique perspective on how you'll get the biggest return on your investment. So welcome, Kenny, to the show for accredited and non-accredited investors. And I'm glad to have you here.
Hey, thanks. It's great to be on the show. Congrats on your success.
Thank you so much, and same to you. So listen, I actually went out to my audience and I told them that I was interviewing you and I wanted to get their questions. So we're going to start off with asking you some questions. And thank you all of my listeners that sent in the questions. Aaron, Carl, Michael, Michelle, Peter, Daryl, and Eric. I consolidated them all for succinct so I can ask them succinctly. So let's just go ahead and get started. So I want to know, Kenny, what is MC Companies? If you could tell us a little bit about that. How many buildings do you own? How many units? And just give us a little 60 seconds.
Sure. Well, I think it's important to start off that I started with a 2-bedroom, 2-bath condo that I bought on my own with my own money. And now we have 10,000 units, 300 employees, primarily in Texas, Oklahoma. We're a ground up, we build them, so we do ground up construction. We own properties throughout the Southwest and Texas, Oklahoma, Nevada, and Portland, Oregon. And I've been in it for over 20 years. I started off in property management and, made the leap over 20 years ago to buy my first multifamily. And I've learned a lot and never looked back.
Wow. Well, congrats. That's amazing story. So do you have another partner that you have this business with? And if so, who is that?
Yeah. Well, he's amazing. His name's Ross McAllister. And, when I first started in the business, I had my own company and Ross had his own company, and his last name's McAllister and mine's McElroy. So that's why we call it the MC Companies. And we're equal partners. And, his primary role in our organization is to assist on the ground up construction properties and also to handle some of the legal and tax, although I'm involved in all of that, of course. And then my primary job is to identify deals, look at acquisitions, and run the operations and then communicate to our investors.
Excellent. So what is the secret sauce to make that work between you and Ross? I mean, finding a partner that you can be successful with is not easy.
Well, partnerships are hard, and I've been in a lot of different ones over the years, and candidly, I think what happens with partnerships is a couple of things. One, I think people don't deliver what they say they're going to deliver. So oftentimes they sell themselves, or they think they can. And I'm not saying that they're lying. I just, they just don't deliver. Ross delivers. And so, Ross is a general contractor. He did a lot of ground up construction before we met. And so, if Ross says he's going to do something, he does something. And if he doesn't know how, he figures it out. And I think, honestly, partnerships can be that simple. And I think a lot of times people are really focused on the money, and they're focused on you know, being an owner or whatever, and their ego and everything, you know, and they don't deliver. And so the expectations for me with Ross is extremely high, and because of that, we have a great respect for each other. We trust each other, and our partnership is pretty powerful.
Yes, I can attest for that. And just for the audience, just so you know, I am a partner in many of Kennin Ross's properties, and they have been very successful. So I just wanted to be forthcoming with who I am in the relationship there, so you know that. So let's just talk a little bit about what you're doing now, Kenny. There was questions from my audience as to what you're buying, and if you're buying multifamily, if you're building multifamily, and maybe if you could share some light on what it is that you and Ross are planning.
Sure. Well, I think that, you know, the interesting thing is just because you have the access to money doesn't mean you should do anything. And I think that, and just because the market was going up last year doesn't mean that it's going to again this year. So we don't believe that it's a good time to buy multifamily personally. That's our own philosophy. And you know, there's a lot of reasons behind that. One is capitalization rates are so low, occupancies are all-time highs, and rent growth are at all-time highs. And so, and then of course, interest rates are all-time lows. So those are four things that are probably at their peaks, although interest rates have creeped up a little bit. But generally, we just don't feel like it's a good time to buy, and we haven't, as you know, for about a year and a half. We are looking, and we still continue to look. It's not that we're not active. We actually had a long meeting yesterday with CBRE in our offices for that exact issue. But what we think is best for us right now are some of this ground up construction, you know, where because we do build, and we're building for, you know, about a 6.5 cap. And you know, the market is selling at you know, below 5. So there's a lot of value right now for us in the construction space, but we're not seeing it on the existing inventory.
Gotcha. And are you looking at specific geographies for even ground up construction?
Well, we just as a company don't feel comfortable branching out nationally for construction. So we're focused on Arizona, and of course Arizona is huge, so it's not really a bad choice. It's just there's so many different markets in Arizona, from Tempe to Phoenix to Glendale to Chandler to Flagstaff to Prescott to Tucson, and you know, and so on and so on and so on, and Scottsdale, and so, which is where our office is. So there's a lot of land, and there's a lot of potential here in Arizona. So we're just kind of focused locally. And we have about 100 million under construction right now.
Wow, that's congratulations. As a matter of fact, Kenny, right before our call, I was on a webinar with Yardi, and looking at different geographies, and they really were focused in on the Phoenix market and calling that one of the high-tech, you know, hubs of the U.S. So it's kind of interesting.
Yeah, and they're certainly trying to make it so.
Yeah, yeah. So you're in a great area. So what signals would you look for to go back into multifamily, like price per door, number of folks invest in finals, you know, from your broker contacts? I mean, are there any like list of economic indicators that would suggest, okay, now is the time for me to go back in and look at buying versus building?
Yeah, it's a very good question. Well, we always try to start, Gena, with the return to the investor. So, and then we work backwards into everything else. So, you know, both the debt and the equity, you know, they need to be paid back, and you always got to keep that in mind. You're always the real reason that we're doing this is obviously for everyone to make money, and if the projects don't make money, then that's actually the reason. So now, what does that mean? What it means is that if if a broker is saying that rent growth is going to be 2 or 3 or 4% per year for the next 3 or 4 years, we might disagree. But you can make the numbers whatever you want to make them. The broker might say that your expenses are going to go down. Again, just an opinion. We don't necessarily think that's the case. And so you start to look at indicators like, what about, what's happening with rent, for example. Now, rent's different in Scottsdale than it is in Tucson, than it is in Chandler, and it is in Flagstaff. So, very different markets. And then as you start to look, you'll see that North Scottsdale, Central Scottsdale, and South Scottsdale are very different. So, real estate's very localized. You have to know all those little nuances, and all those little things make up whether or not a property is going to be good or not. And of course, like anything, if you pay too much for it, then it's not going to do as well. And so right now, what we're seeing is unrealistic projections by brokers and sellers, and a lot of money buying properties right now. So that's driving the prices up. So the prices are high, the expectations are high, and we just don't think that it's a good time to buy based on what I started the question with, which was, what are the investor returns? Because at the end of the day, whatever you buy it for, whatever it's operating at today, whatever the cost of your debt and equity might be today, it'll show you what the return is. So it's not rocket science. It's not like we think it's going to do this. You can actually take a property today that's operating today, put new debt and equity on it, and see what does it produce. And so the sales job right now with everybody is, well, we think we can improve it. And so that's actually the big question mark is, can they or can't they? And is the market going to support them?
Yeah, and that's what gets me into this definition of value add. I think that term is used very broadly. And I have a definition of it, and I think you and I share the same definition, but it may not be the same thing as the definition of what these brokers are saying it is.
That's another good observation. Also, value add, I'll tell you what I think it is. It's now a catch-all phrase for everything.
Yeah.
So, for me, value add is taking a 20-year-old building and putting $6,000, $7,000, $8,000, $9,000, $10,000 inside of the unit in the form of new appliances, new paint, new flooring, and new countertops and those kinds of things. And then knowing that your rents are going to go up $100 or $150 a month. That to me is what a value add is. So in other words, it's no different than renovating the inside of a house and selling it for more. It's the exact same thing. Now, it's interesting because you can do that in markets today and not get any more rent. So you have to be sure that you're going to get more rent. So, but typically you can take something that's 20 or 30 years old, spend money on it, and charge more. But guess what renters are not going to pay more for? They're not going to pay more for a parking lot. They're not going to pay more for a roof. They're not going to pay more because you painted the outside, and they're not going to pay more for a kid's play area or a dog park, okay, or a new gym. They're going to expect those things, and they're going to pay more for interior upgraded units. And so that's what I feel like a value add is. What people are, that buzzword is used a lot right now, and it's all over the map. Uses it very loosely.
Yeah, I've seen that, and it's just, I call it kind of like putting lipstick on a pig, and I think it's not being completely forthcoming with what our definition is. So it's a mismatch in general.
Right.
Yeah. So let's go into value add a little bit more as to how difficult is it to do that type of value add today versus 5 to 10 years ago. when you would see many more opportunities where you could increase the NOI? And what are some of those factors, such as high valuations, cap rates that are rising, interest rates, and flat income growth, for example? Are you seeing those things that's making you not see value add opportunities as much as you used to?
Yeah, I think you know again, it's actually a pretty simple business. If and I think sometimes people tend to make it really complicated. And what I mean is, we'll just pick on a market, that we're in. Like we're heavily invested in Tucson, for example, and we have like 2,000 or 3,000 units down there. And you know, there are areas of Tucson that everyone wants to be, and it's progressive. Maybe there's a new employer, or maybe it's around the University of Arizona where they're expanding, and or whatever. And then there's areas that are not as progressive, just like in any town. And so the areas that are not as progressive, and you're just not going to get rent growth because you don't have the demand of the renter. So if you have like the area around University of Arizona, for example, there's a big demand, and of course, a big demand for housing and a shortage, right? So just as an example, I'm in the business. I'm paying $1,500 for my son to live near the campus for a studio. And of course, I own a lot of property in Tucson, and so that is very high for downtown Tucson, and near the university. But but if you go 3-4 miles away, that exact same thing is going to be $800.
Yeah.
So I just think it's just real common sense. And so you're going to pay more for something, let's say near University of Arizona, but your potential of keeping it full and having higher rent growth and all that stuff will be better. So you know what I mean?
Yep, I see. Okay, no, thank you for that. So
Sure.
let me ask this, because there's different classes of properties, A, B, and C. And right now, the cap rates are kind of similar across those different classes. Are you noticing that same phenomenon? And if you are, how can you explain or reconcile that?
Well, first of all, I think we got to talk about what a cap rate is. Cap rates are just the net operating income divided in whatever the property sells for.
Yeah.
So that's what a cap rate is. And so what's happening, Gena, is that there's so much money chasing apartments that we're getting very, very high prices. And so, we're starting to see these cap rates, super low numbers. As we listed 2 properties, and we had offers in the first 2 weeks at 4.75 caps, and we bought them at 6. And so that extra 1.25 cap is a lot of money for the investors, which is why why we listed them, because I just don't think that these cap rates are going to stay at the levels that they're at. I think they have to go up, and so we're trying to sell some properties now and return some cash to the investors, so that hopefully we can rebuy at a later time when they go up.
I see. Okay. Interesting. Thank you.
Uh-huh.
How can one use debt? You use this term debt is tax-free a lot. So can you explain what you mean by that?
Yeah, great question. It's really quite simple. Debt is money that you owe back to somebody, as you know. It could be from a bank, it could be from an insurance company, it could be from a pension fund. You get money from pretty much anywhere, even privately. And so when you borrow or get a loan from somebody, it's owed back. And so you actually don't pay tax on that because it's a loan. You know, you don't pay tax on debt. Now, that's why you just think about it on a single family level. People talk about those cash out refinances on their homes, let's say. Fortunately or unfortunately, a lot of people use those to buy, new furniture or new boats or new cars or whatever. And, I'm not bashing on them for that, but the point is it's not taxable. It's a second mortgage on their house. So that's essentially all you're doing is you're just refinancing and scooping whatever equity you might have and distributing it out. And because it's because it's a loan, and that means it's not taxed. So, it's really that simple. Now, if you sell a property and you get all that money back, now you have a taxable event, right?
Yeah.
But as long as you're using debt, it's not taxed.
Yeah. Yeah. No, it's a great way to build wealth